Today, the October effect. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In our weekly roundup, we'll start with the US, go across the European markets and into Asia and end up in Australia. Another really strange week, frankly, and more to come, I think. After the rout of September, I'm sorry to break this to you, but stock markets historically have experienced well above average volatility in October. It's often a spooky month for stocks, and several of the greatest crashes in stock market history have occurred during the month, including Black Tuesday and Black Thursday in 1929, as well as Black Monday in 1987, and the worst of the 2008 financial crisis meltdown. In fact, some have dubbed this the October effect. Guggenheim Securities Chief Investment Officer Scott Minard said that he expects stocks to fall another 20% by mid-October, citing a connection between price-to-earnings ratios and inflation. We should see stocks fall another 20% by mid-October if historical seasonals mean anything, Minard said. The Fed's already raised its benchmark interest rate by 300 basis points this year as it fights to bring inflation back under control, and more hikes are expected. We will get more data, of course, during the month, but one to watch is the feedback loop between US stocks and bonds. With the third quarter over, both assets have seen painful sell-offs. The S&P 500 is down nearly 25% year to date, and the ICE Treasury Index has fallen by around 13%. The twin declines are the worst since 1938, according to BOFA Global Research. The S&P 500's forward price-to-earnings ratio fell from 20 in April to its current level of 16.1, a move that came alongside a 140 basis point surge in the yield on the benchmark US Treasury bond at 10 years, which moves inversely to prices. But bonds have led the dance, with soaring yields slamming stock valuations as market participants recalibrate their portfolios to account for stronger than expected monetary tightening from the Fed. Interest rates are at the core of every asset in the universe, and we won't have a positive repricing in equities until the uncertainty of where the terminal rate will settle is clear, said Charlie McElliott, Chief Director of Cross-Asset Strategy at Nomura. Volatility in US bonds has erupted in 2022, with this week's Treasury yield gyrations taking the bond market option volatility estimate index to its highest level since March 2020. By contrast, the COBE volatility index, the so-called Wall Street's fear gauge, has failed to scale its peak from earlier this year. We have emphasized that interest rate volatility has been and continues to be the main driver of cross-asset volatility. Nevertheless, even we continue to watch the rates volatility complex with incredulity, analysts at Societe Generale wrote. Wee Lee, chief investment strategist at BlackRock Investments Institute, believes more jumbo rate hikes from the Fed may dent growth, while a slower pace of tightening could hurt bonds by making inflation more entrenched. She's underweight developed market equities and fixed income, believing that difficult choices faced by central banks will spur more market ructions. Equities may have further to fall than bonds, given the high likelihood of a recession in 2023, said Keith Lerner, co-investment officer and chief market strategist at Truist Advisory Services. We think the upside for equities will be capped because there will be more earnings pain and more central bank tightening, he said. Now, it's likely the wild moves will continue until there is evidence that the Fed is winning its battle against inflation, allowing policymakers to eventually end monetary tightening. But that could be, well, a year or two away due to the stickiness and breadth of inflation. Hence, more hawkishness is on the menu. The data on Friday on US personal consumption expenditure, the PCE, for August showed that it increased 6.2% from 1 year ago, reflecting increases in both goods and services. Energy prices increased 24.7%, while food prices increased 12.4%. Excluding food and energy, the PCE price index for August increased 4.9% from a year ago. The PCE is, of course, the Fed's preferred inflation measure, and it shows that inflation rose more than expected in August. This compounds the pressure for the Fed to stay on course with its fight against inflation. Real disposable personal income increased 0.1% in August, and real consumer spending increased 0.1%, while services increased 0.2% and goods decreased 0.2%. Within services, the leading contributors were healthcare and transportation services, and within goods, there were decreases in both durable goods, led by recreational goods and vehicles, and non-durable goods, led by other non-durable goods. So, on a monthly basis, the PCE index actually grew more in August than in July, rising 0.3% from a previous decline of 0.1%. And economists had expected a monthly growth of just 0.2% in August. This means that inflation is still raging. Fed Vice Chair Lael Brainard on Friday cautioned against the central bank reversing course on monetary policy too early, saying monetary policy would need to be restrictive for some time to have confidence that inflation is moving back to target. So the Fed's rate hike program hasn't yet had a material impact on the consumer, suggesting a deep recession isn't on the horizon yet, and they will need to lift even higher to crush inflation. And of course, the Fed's next meeting isn't for some time, but investors on Friday afternoon were pricing in a 62.7% chance that the US Central Bank will hike rates by 75 basis points on November the 2nd when it meets again, up from a 0 chance 1 month ago, according to CME's FedWatch tool. Markets see rates hitting a peak of 4.5% in July 2023. That's up from 4% a month ago. And next week's US employment data will give investors a snapshot of whether the Fed's rate hikes are indeed starting to dent growth. Investors are looking at earnings ahead, which will start to be reported in October, as they gauge to what degree a strong dollar and supply chain snafus will affect companies' profits. But for now, investor sentiment is largely negative, with cash levels among fund managers near historic highs, as many increasingly choose to sit out the market swings. Retail investors sold a net $2.9 billion of equities in the past week. That's the second largest outflow since March 2020, according to data from JP Morgan. And JP Morgan also said that high cash allocations might provide a backstop for both equities and bonds, likely limiting future downside. Well, we'll see. At the same time, the fourth quarter is historically the best period for returns for major US stock indices, with the S&P 500 averaging a 4.2% gain since 1949. But dip buying has fared poorly this year. The S&P 500 has mounted 4 rallies of 6% or more this year, with each rebound spluttering out to be followed by fresh bear market lows. In terms of the markets, the Dow fell on Friday, rounding off its worst quarterly losing streak since 2015 that has pushed stocks into bear market territory as investors prepared for future Fed rate hikes to cool inflation. The Dow Jones Industrial Average fell 1.7%, the Nasdaq was down 1.5%, and the S&P 500 also fell 1.5%. All three major averages fell for the third straight quarter. Losses were broad, though more modest than some sessions this week. Utilities slid 2%, but real estate was 1% higher, and the volatility index slipped 0.7 to 31.62. Nike stumbled nearly 13% following quarterly results that beat Wall Street expectations, but the sportswear giant cut its outlook on gross margin as price cuts will be needed to clear inventory levels. They lowered its gross margin forecasts by 200 basis points due to the need to aggressively discount mistimed inventory as a result of supply chain challenges, Goldman Sachs said, after cutting its price target on the company to $98 from $120. Micron Technology, meanwhile, was flat as investors weighed the chip maker's softer guidance delivery after better-than-expected results. And Rent-A-Center slumped 21% after cutting third-quarter guidance, and consumer demand came under pressure from weakening economic growth. The yield on the 10-year note was 4 basis points higher at 3.83%, while the 2-year Treasury was at 4.2726, still in inversion territory. Oil bulls wallowed in another day of losses on Friday after a surprisingly high US inflation print for August reinforced expectations for more supersized Federal Reserve rate hikes. US crude's strong run-up between Tuesday and Wednesday, however, helped the market in good stead for a small weekly gain 1 in 5, despite major losses for September and the third quarter, the first quarterly loss for oil in 2 years. Oil bulls were also charged up ahead of next week's meeting of the OPEC Plus alliance of 23 oil producers and exporters. The 13-member Saudi-led organisation of the petroleum exporting countries and its 10 Russia-steered allies are to meet on October the 5th to finalise output quotas for November. New York traded West Texas Intermediate for November delivery settled at $79.69 a barrel. That's down 2.1% on the day, and for the week WTI was up about 1%. For the month, however, the US crude benchmark was down 12.5%. For the third quarter, it was down 24%. Brent, the London traded global benchmark for oil for delivery in December, was at $85.32 a barrel, down 2.3%. Unlike WTI, Brent was also lower on the week, losing 1.2% for a fifth straight weekly decline. For the month, Brent was down 11%, and for the quarter, it lost about 26%. The crude demand outlook is not getting any favours from economic data or corporate reports. OPEC Plus will have an easy job next week, but oil prices won't catch a bid until energy traders are confident an aggressive reduction in output of around 1 million barrels per day will be delivered. Brent crude is poised to consolidate below the $90 level. Of course, Russia is pushing OPEC Plus to cut output by a substantial 1 million barrels per day or around that, but Moscow is unlikely to contribute much of any production cut by the alliance due to the ongoing impact of its energy exports from Western sanctions imposed over its invasion of Ukraine. The Russians also have been undercutting others in OPEC Plus by selling their crude at heavily discounted rates to buyers like China and India. A production cut by OPEC Plus that Moscow does not fully participate in will benefit Russia more than the rest of the alliance, as it might continue to steal customers from the others. Also, OPEC Plus has not met its monthly production targets for months, so any quota announced by the group might be virtually meaningless. Case in point here, a Reuters survey published on Friday has found that OPEC Plus raised its September crude oil production to the highest level since 2020, yet failed to meet its September quota. Thus, on the way down too, the alliance might fall short of its target. Gold prices perked up a bit for a fourth day in a row, hitting a one-week high after a largely miserable September for longs in the game. For the month, though, bullion was down 3%, while for the quarter it was down 7.5% for its worst quarter since March 2021. Gold's benchmark futures contract was at $1,670 an ounce. Gold is often seen as a store of value and a hedge against inflation and Fed rate increases. Despite the price recently hitting a 2-year high, it has been an inferior hedge and the opportunity cost has been high, Reuters Breaking Views analyst Robert Siren said in a commentary on gold on Friday. An investment 10 years ago in the S&P 500 index would have tripled. Now in the UK, more than half of Britons think Liz Truss should quit as UK Premier, according to a YouGov poll that adds to her woes less than a month into the job. The survey on Friday underscores the damage done to Truss's standing and that of a Conservative Party by the huge package of unfunded tax cuts her government unveiled a week ago. Some 51% of almost 5,000 Britons surveyed said the Prime Minister should quit, with 54% saying Chancellor of the Exchequer Kwasi Kwarteng should resign. Bringing some support to sterling, the Bank of England has bought £1.195 billion worth of long-dated government bonds at a daily operation designed to calm markets. That's down from the £1.415 billion on Thursday and well below its £5 billion maximum. The UK 10-year Treasury was at 4.123, while the 30-year was at 3.851, so yields are down a little. The FTSE, the index of the largest 100 stocks in the UK, was up 0.18% to 6,893. That's a small bounce, but frankly I don't think anyone is getting excited by the move that pales into comparison with the losses that preceded them. The steep decline reflects the expectation of higher rates. Indeed, some are talking that the Bank of England could be hiking by more than 1% next time in response to the policy announced last week. And we saw a third day of gains for the pound, which has now recovered the bulk of the losses sustained after the mini-budget a week ago, and it ended up 0.51% at 1.1172 to the US dollar. Now, this is not a sign of investors coming around to the new Chancellor's unfunded tax cutting, but rather a reflection of the work done since to calm market reaction. That includes the emergency interventions from the Bank of England, talks of measures to balance the costs of the tax cuts, reported discussions with the Office of Budget Responsibility, and rumoured unrest within the Tory party. We'll have to see what that amounts to, and sterling could certainly react negatively again to inaction or the wrong action. But UK GDP data brought some good news, although it was far from positive really, because the UK is not in recession after the second quarter GDP was revised up from minus 0.1% to plus 0.2%. While all positive revisions are welcome, the technical recession wasn't really significant in the first place. The important thing was that the UK is struggling to grow and facing a probable deeper recession down the road, and today's revision, well, doesn't change anything really. The UK is the only G7 country with a smaller economy than in early 2022 before COVID. Meantime, inflation is still a bane. A Reuters poll found that the Bank of England was unlikely to raise rates before its next scheduled policy meeting in November, despite a recent hit to sterling from its controversial economic growth plans announced last week. But in the Eurozone, inflation hit 10% in September. That's ahead of schedule, with markets expecting a jump to 9.7% from 9.1%. And within that, energy was up more than 40%, and food, alcohol and tobacco was up close to 12% in August. In normal circumstances, that might have triggered a reaction, but these are anything but normal times. Markets are still pricing in a more than 70% chance of a 75 basis point rate hike from the ECB next month, with an outside chance of 1%. The euro was slightly lower, down 0.13% to 0.9801 against the US dollar following the release, which also showed core inflation rising a little higher than expected to 4.8%. And of course, on the geopolitical front, President Vladimir Putin's proclaimed Russian annexation of a swathe of Ukraine, even as Russian forces face setbacks on the battlefield. The Russian president's proclamation of Russian rule over 15% of Ukraine has been firmly rejected by Western countries and even many of Russia's close allies. European shares climbed on Friday, but saw sharp losses during a quarter marked by rising interest rates and tumbling risk sentiment, with hot inflation data from the region keeping investors on edge. The region-wide Stoxx 600 index closed up 1.3%, but had briefly paired some session gains after the inflation record high. The inflation numbers fueled expectations of another supersized interest rate hike from the central bank. All of the stocks sectors ended the day in positive territory, with bargain hunting driving gains among some beaten down retails, oil and gas and bank stocks. The Stoxx 600 index has fallen 4.8% during the July-September period, marking its third straight quarterly decline in what will be its longest such losing streak since 2011. Meanwhile, inflation in the Netherlands touched its highest in decades on skyrocketing energy prices, adding to concerns around grim inflation numbers from Germany that was reported on Thursday. At the same time, French inflation unexpectedly slowed in September as consumer prices rise in the euro area's second largest economy by 6.2% from a year ago, down from 6.6% in August. Shares of German sportswear maker Puma and Adidas slid 5.7% and 4.1% respectively after US rival Nike cautioned about pressures on margins. The DAX in Germany trades at 1.6% higher to 12,114, while the CAC 40 in France rose 1.51% to 5,762. In Asia, Asian stocks tumbled on Friday and were set for deep monthly losses as a worsening outlook for the global economy and continued hawkish signals from major central banks decimated appetite for risk-driven assets. Official data from China showed that the manufacturing activity unexpectedly grew in September, breaking 2 straight months of decline, but a separate private survey by Casin painted a very different picture as the country's manufacturing PMI shrank to 48.1 in September from 49.5 in the prior month. China's PMIs highlight the widening gulf between the performance of state-owned firms versus their private competition. It goes without saying that being backed by the state in uncertain times like this carries certain advantages, and that's been evident for some time. Private firms have been more sensitive to COVID restrictions and have therefore been heavily hampered this year. Still, even with those state-based benefits, the headline PMI was far from encouraging, rising to 50.1 and barely in growth territory. And with the non-manufacturing PMI also slipping from 52.6 to 50.6, it's clear that the economy is still facing enormous headwinds and that the global economy stalling around it will only add to them. Meanwhile, the Bank of Japan ramped up bond purchases overnight as it continues to defend its yield curve control thresholds in volatile market conditions. Rising global yields have forced the central bank to repeatedly purchase Japanese government bonds in order to maintain its target. There has been a growing expectation that the Bank of Japan could tweak its 0% target or widen the band it allows fluctuations between in order to ease the pressure on the currency. But that has not been forthcoming, with the Ministry of Finance instead intervening in the markets for the first time since 1998. So the intervention doom loop there seems to be set to continue. Regional stocks took a weak lead in from Wall Street indices, which slumped in overnight trade as investors worried that interest rate hikes by the Federal Reserve will dent the economy. Technology stocks were the worst hit, with tech-heavy bourses in Asia also severely lagging behind their peers in September. Hong Kong's Hang Seng Index shed 14% in the month, while South Korea's Kospi and Taiwan's weighted index lost around 11% each. Japan's Nikkei 225 was the worst performing Asian bourse on Friday, down 2.1%, despite better than expected industrial production and retail sales data. A weakening yen and rising commodity prices are expected to weigh heavily on the Japanese economy this year. And the Nikkei was also set to lose about 8% in September. That's the worst month since March 2020, during the onset of the COVID-19 pandemic. Most other regional indices were set for a similar monthly milestone. Asian stocks have tumbled this year on growing fears over a slowdown in economic growth amid hawkish signals from several major central banks and weakening economic prints across the globe. The Shanghai Composite fell 0.55% on Friday to 3,024, with a monthly loss of nearly 7%. The Hang Seng was down 0.33% to 17,222, while the Nikkei was down 1.83% to 25,937, and the Korean Kospi was down 0.71%. In Australia, the local currency tumbled, briefly trading below 64 cents US. It actually ended at 64.03 on the strength of the US dollar. With no definitive signs of an exhausted trend, we would either need to see base building develop on top of the 63.64 cents on September the 28th, which is a low, or an immediate rebound above 66.69 to 67.05 cents to derail some of the recent bearish momentum, JP Morgan strategists said. The S&P ASX 200 posted its third day in the red over the week to finish 1.2% lower at 6,472. Over the week it fell 1.5% and now sits 1% below its June 2022 low of 6,407. The only sector to finish higher was materials on gains among iron ore and gold miners. Iron ore futures in Singapore for delivery in October sat at 95.46 a tonne, and that helped BHP Group advance 0.9%. The gold price also extended a two-day rally as investors bought the metal as a safe haven, and Newcrest Mining firmed 2.7%. The biggest loser on the benchmark was car sales, which was down 7.8% after the auto retailer warned inflation was reducing demand for used cars. The yield on benchmark risk-free 10-year treasuries was down 1.21% to 3.907, while the 2-year was down 0.86% to 3.477. The ASX 30-day interbank rate came back closer to 4% in the out months, but it still remains above 4% in February 2024. And shares in A2 Milk edged 0.6% higher after it told investors that first quarter sales were marginally ahead of plan because of foreign exchange gains driven by the depreciation of the New Zealand dollar. Northern Territory-based lithium darling Core Lithium entered a trading halt on plans to raise $100 million at $1.03 a share on a 6.8% discount to its last closing price. Management said the capital would help it deliver first lithium concentrate from its Finniss project in the second half of 2023. But banks were down, with ANZ down 2.44% to $22.80, CBA was down 2.6% to $90.70, NAB was down 1.57% to $28.81, and Westpac was down 2.27% to $20.64. And Macquarie dropped again, down 4.24% to $152.74 on global recession exposure. And in crypto, It's been a very choppy week with Bitcoin, which has failed to make a sustainable run in either direction despite attempts at both. Perhaps we're seeing a floor forming a little shy of the early summer lows around 17,500, although that will much depend on risk appetite not plummeting once more, which it very much has the potential to do. It's stuck at its current range with risks to the downside. It was last at 19,414, while Ether was at 1,330. So, with the S&P 500 down more than 20% on the year and showing no signs of hitting a floor, remember the valuation for the index remains elevated and earnings estimates have only started to turn lower and may fall further as earnings seasons near. Additionally, high-yield spreads are widening and volatility measures show that investors' mood is complacent. When these levels spike, well, that might be when a bottom is likely to be near. The overriding factor sending stocks lower is higher rates, and while there are early signs that year-over-year headline inflation rates may have peaked in some places, they aren't coming down sharply either, and they've been hovering in the 7 to 9% range for several months. It makes finding a bottom in this market much more challenging because we do not know the pace at which inflation will fall or how high the Fed may need to raise rates to get it there. So, are we in the too cheap to ignore range for stock yet? Well, except for the 2009-10 financial crisis recovery, we've seen the S&P 500 bottom around 12 to 13 times one-year forward earnings estimates. Currently, the index is trading around 15.3 times 2023 earnings estimates, so no, although of course specific stocks do vary. Additionally, at this point, the corporate BBB spread over the 10-year Treasury rate is still rising, while also not reaching prior peaks seen at market bottoms. The major market bottoms in 2003, 2009, 2011, 2016 and 2020 saw this spread rise above 2.3%. The only time the spread did not rise above 2.3% was in 2018. So given the rising rate environment, the spread between junk bonds and treasuries seem unlikely to fail to reach that 2.3% threshold. And at this point, we have failed to see the VIX index make a substantial move higher. And historically, it's when the VIX closes above 36, following a very sharp move lower, that we tend to start a bottoming process. At this time, the S&P 500 continues to make lower lows, while the VIX has made a series of lower highs. So while the market can bottom and bounce anytime, history suggests that this current bear market cycle has yet to play out entirely. It isn't clear at this point whether inflation has peaked or when this Fed rate hiking cycle may end. And until some of those critical points can be answered, it seems unlikely for a bottom to have been reached. And if you look at all of the information that we've got in front of us, we should expect markets to fall further and volatility to continue to increase in the next few weeks. October is not a sunny month, and therefore expect markets to drop further. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.